I'm here in Dallas for REITWorld 2011, NAREIT's annual convention for all things REIT. I'm joined by Mark Zalatoris, the President and CEO of Inland Real Estate Corporation. Mark, in your third quarter earnings call, you noted that occupancy has improved so far. What is driving your company's improvement there?
Well, Matt, for us, we've been very fortunate in that where the majority of our properties are located, mainly in Chicagoland and then Minneapolis, St. Paul, there's been a number of new market entrants, and we've been fortunate enough to do a number of leases with them, namely Ross Dress for Less, where we did 6 of their first 12 new stores in Chicago, and Gordmans came into Chicagoland, as well as H.H. Gregg. So we've been very fortunate in that we've been the beneficiary of their market expansions into our markets, as well as there are some of our current retailers that are doing some right sizing, so to speak, and we've been able to offer them the right type and size of space and have drawn them from competing centers. So we've again been fortunate for the stronger retailers that want to move into better locations in the right size space. We have that to offer them.
And you also referenced in your call about the capital you have available for acquisitions. What type of assets and in what locations are you targeting? Well,
we're continuing to target our main 2 areas where our majority of our portfolio is located, and the capital that we have comes from a Dutch pension fund advisor, PGGM, who actually has the same desire to invest in the core assets, namely grocery-anchored, convenience-based centers, necessity-based, in the particular markets in which we operate. They are actually targeted the upper Midwest. Chicagoland and Minneapolis, St. Paul are the first 2 target markets where the majority of our assets are, but they're also want us to look into other areas of the upper Midwest where we do have some assets, but including new areas like Columbus, Ohio, and Cincinnati, where we found that market pricing is a little bit more attractive than it is in Chicago. So we're actively pursuing that in those areas for them, and I think that we'll have a few new ones closed for them in those markets in the near future.
And I'd like to end with a 2-part question. Looking at 2012, what has you most optimistic and what has you most cautious?
Well, most optimistic is the fact that there is capital available, particularly from our partners, and there's acquisitions, quality assets that are hitting the market, and also we're working with some of our developer partners that we've done business with in the past on off-market deals, and this year particularly we've been very successful. I expect that to continue. So I see us having a robust pipeline of new acquisitions going into 2012, and the fact that the retailers feel very optimistic about the future, so that they're continuing to express a desire to expand, and like we said, the new market entrance we've enjoyed in 2011 will continue in 2012. What I'm concerned about is more on a macroeconomic basis, where European contagion could possibly spread back to the United States, and investor sentiment, or actually consumer sentiment, is what will affect our retailers in a negative way, and if it does turn negative, their expansion plans may be scaled back, and that would eventually trickle down and affect us.
Well, Mark, thank you very much for joining us.
My pleasure. Thank you.
For more from REITWorld 2011, be sure to visit REIT.com.